Hello, everyone, and welcome back. My name is Greg Furman, and this is the Vantage Point AI Market Outlook for the week of October the 9th, 2023. Now, to get started this week, we'll begin with the US dollar index. Now, we're coming off the non-farm payroll number, which I'll elaborate again, in my respectful opinion, only of that labor report was actually not a great number. Again, I'll talk more about that in a minute, but let's look where the dollar is on the calendar year. Now, right now, from again, we want to make sure that we're not getting involved with chasing markets with rolling performance. We want to look at where we're at from a seasonal standpoint and where we are in the calendar year. The dollar is up a mere 1.73%. So again, guys, when we look at this, that tells me the dollar, again, is nowhere near as strong as what they're suggesting. But I don't want to get involved with the last 5 days, the last 30 days, the last 90 days. I want to look at where I am in the calendar year, and then I can apply my seasonal patterns to that. The seasonal pattern here, as I've discussed over the last few weeks, or the last few months for that matter, in the Vantage Point Live trading room, is that this is probably one of the worst times of the year for the dollar going into the calendar year end, which usually the other markets benefit from. So when we look closer at the unemployment number from Friday, the dollar initially out of the gate rallied, but it rallied based on a household survey number, the U3 number, which basically looks at the essentially the last 4 weeks. That's it. So when we look at the U6 number and we do a comparative, which again confuses me why the Fed is not looking at the same thing. If we go back to September 2022, we're at 6.7%, but if we look at August 23, we're at 7%. This is actually going the wrong way because we're looking at the real unemployment, as you can read, total unemployment plus all persons marginally attached to the labor force plus total unemployment part-time for economic reasons as part of the civilian labor force plus all persons marginally attached to the labor force. So we get a better insight into what this labor report really is. Now, the unemployment rate did not go down. The numbers from September or excuse me, August were revised up, but again, based on a household survey number. And if the unemployment was a number, or the situation was as strong is what the Fed is trying to spin here, then these numbers would look very different. So again, in my respectful opinion, looking at the labor rate participation rate, average hourly earnings, it was not a great labor report at all. And the U6 is the way at least I will look at this and say, okay, are things moving in the right direction? The answer is no, they're not. So again, that's something we want to look at. So when we do that in comparative analysis to the dollar index and the seasonal pattern that I've discussed over the last, throughout this calendar year, that the dollar is always strong in the first week of the new month, then mysteriously, regardless what that payroll number is, the dollar very often sells off mysteriously. So we are in a holiday short week next week. It's Thanksgiving in Canada. I believe it's Columbus Day on Monday in the US. So by midweek, we would be looking to see if this seasonal pattern will take hold and the dollar will sink once the market has had more time to actually digest that number. So when we look at it right now, again, this really does matter that the dollar is really almost flat on the year. And I would argue we were in a very similar situation in March of this year where they said only buy dollars, don't buy Bitcoin, don't buy oil, don't buy gold, don't buy stocks, all of which was horrifically wrong. So again, we want to remember what happened back in March and apply the data. So if we look at the indicators in Vantage Point right now, we are moving lower. Our neural index strength is somewhat sideways. I do anticipate initially out of the gate the dollar would be strong on Tuesday, but it's Wednesday and Thursday of next week. We want to keep an eye on this because again, I think that once they look closer at this labor report, I'm certainly not betting on the US dollar based on the U3 number, on a household survey number, or any revisions to that number. I will always go and look to see if the unemployment rate went lower. It didn't. Did the U6 go lower? No, it's going higher. It's slightly lower from the previous month, but from September 22 to now, again, only in my respectful opinion, I feel it's going the wrong way. So these indicators in Vantage Point are picking up on that. And again, when we look at the beginning of the week, you can see right out of the gate the dollar rallies, and then by the Monday, Tuesday reversal, long before that payroll or ADP report came out, the dollar was moving lower. So again, one of the tools that I've used over the years, using some of the additional indicators in Vantage Point to identify these intermarket correlations, I look at Magna International stock. There's about a 92% inverse correlation. So I've been watching the Magna stock, the MGA stock, this particular week, and this is exactly what I've been looking for. For this stock to start rising. The neural index strength confirmed what I already thought, that the dollar will likely not hold these gains, but I look to the Vantage Point indicators. Now, this is showing momentum on this particular stock. Now, again, when we look at that, the neural networks are able to pick up on these inverse and positive correlations. And this inverse correlation using the bull bear gauge in the Vantage Point software, I noticed this about 2 years ago, and I've been monitoring it ever since as a reversal or a contrarian indicator. So as long as this stock is moving higher, then that tells me the dollar may not be what it appears to be. Now, the additional tool that we want to bring into this when we're looking at the dollar index is an accurate quarterly opening price. So for the dollar to remain bullish, again, we're starting a new quarter here. We don't want to get involved with rolling performance, guys. It's extremely misleading and it's lagging. We're looking to see if we can, I'm a happy buyer of dollars as long as we can hold above 106.21. If we can't, it's confirming that that seasonal pattern in the dollar is that it's going to weaken. I can't remember any year on record, even last year, where I was buying dollars after the middle of basically October, and November was even worse. But December is not, again, is not a month I'm looking to buy in that US fiscal first quarter. Most people don't realize that. The US fiscal fourth quarter ended on October the 1st. So again, for next week, if we're holding below 106.21, then that's confirming that the dollar is likely peaked on the year, just like it did last year, guys. When we do a comparative analysis, looking at an accurate view of the performance of the SPYs, we're up 12% on the year, guys. And again, we get all caught up in this rolling performance. We've got 1 week they're saying we got bullish momentum coming into the market. The next week they're saying we don't have bullish momentum. Well, pick one. Which one is it, guys? Right? So when I look at it from a year over year perspective, to be clear, I fully endorse. I'm not interested in buying necessarily treasuries, but in Canada, at least, we have high interest savings accounts that are not locked in and are paying for anywhere between 4 and 5% per year. Absolutely take the low-hanging fruit, guys, for sure. But always understand where we are in the stock market. And so the SPY's up 12% still on the year. The S&P 500 still up 12.5% on the year. That grossly outperforms T-bills and even high interest savings accounts. But again, it's never an easy, it hasn't been easy, let's just say that. But I encourage to go where the money is going. So right now, when we look closer at the S&P 500, we're looking for the dollar to turn down. If it turns down, then I am absolutely still going to at least diversify some of the portfolio into the stock indices. It makes sense for me to do that. But for now, I'm also going to leverage that quarterly opening price using the point in time indicator from Vantage Point. That's 42.84. So I have a line in the sand that's indiscriminate. I don't care what the last 5 days or 30 days or 365 days in a rolling performance model, because it's not relevant to anything. It's consistently produced false and lagging signals. So when I say, I can definitively say, okay, I have no bias either way. But if I'm holding above the quarterly opening price on the S&P 500 and I'm holding below the quarterly opening price on the dollar index, then I'm gonna also take this particular low-hanging fruit. But again, I am a happy seller of the S&P 500, providing we can consistently hold below 42.84. And on the SPYs, again, when we look at it from an accurate standpoint using the current yearly opening price and more specifically the current quarterly opening price, then we can identify this and say, okay, 426.62. We've closed moderately bullish at 429. So as long as we're holding above that level, then that gives us, again, a very simple methodology is that, okay, we're going into the fourth quarter. If we can hold above this, we've got upward momentum, right? So when we look at this right now, another example of using the current yearly opening price and avoiding lagging rolling performance models is that there is no support here, guys, other than the yearly opening price. And again, in gold is a slightly different animal here. The quarterly opening there is 1848. So I could take the position that, okay, we're holding above the yearly opening price. If I can, or I could say, okay, I'm going to stand down here for now and I'm going to put limit orders just above 18, the monthly opening or the quarterly opening at 1848. And I know that once I get above that, that will confirm that the dollar is moving lower. Magna International stock is moving higher. S&P 500 is moving higher. So I can connect the dots between these intermarket correlations. And I have no bias either way. If you want to go long, short, I'm all for it. But I need a plan, and it must be a plan based on price action, intermarket correlations, and the current trend. The current trend in gold has clearly been up in 2023. So this is a good corrective move that I saw basically the same thing last year. And that's one of the arguments that I've made is that, okay, well, we basically bottomed out on October the 20th of last year and gold started to rise. Now, was the Fed hiking interest rates in January, February, March, April, May of this year? Yeah, he was. So again, we can make that argument about the Fed and hiking rates. And again, looking at the labor report, I'll look at a number of different tools here, guys. I look at the inverted yield curve, strike one. The economic data that's coming out is clearly showing contraction. That's strike two. And then we have a pending recession. I believe that's strike three. So in that particular scenario, good, bad, or indifferent, right? Or it's not about being right or wrong here, guys. It's just understanding that gold usually goes up in a recession. And when I look at the accurate labor report from Friday using the U6 number, labor rate participation, average hourly earnings, I'm scratching my head saying, how is that how is that a good labor report when the U6 is now at 7% versus 6.7 the year before? So again, yes, the gold could crash lower, but the main thing is we need to identify these levels that in actual fact, one could argue that this is a premium long down here. But again, I'm a happy seller of gold provided we can stay below that yearly opening price at 1824. And very often this is what happens. They flush the market out and then it's about to turn. So when we look at the Vantage Point MA diff cross, I will respectfully submit that this is why I went long on Tuesday of this previous week, because Vantage Point clearly identified that it's at least in the short to medium term, in this particular downtrend, current downtrend, it's getting ready to turn back up. Now, you'll remember in the previous weekly, because again, this is an outlook, guys, not a recap of something that's already happened. I've talked about this a month ago that if gold is going to turn, it's going to be around October the 14th. That's what I would be looking for because that's when the dollar is likely going to turn lower based on a 5-year 10-year seasonal pattern. The other thing with gold is over the last 10 years, indisputably, over a 10-year period, it's been bearish between October and year end. However, over the last 5 years, 80%, this trend is shifted to the upside, and that is just clearly showing the depreciation of the US dollar, of the Canadian dollar, of the Aussie dollar, the euro, as the global governments continue to print money. This does not benefit any one of these currencies. But again, when we look at this right now, the angle of the neural index strength, and again, that forewarning sign that gold would likely rise after the non-farm payroll number. Again, I believe that this price that we see on Friday with this move up is accurate because somebody has looked closer at that labor report and probably similar to me has been left scratching their head saying, well, wait a minute. We're basing this strong labor report on a U3 number based on the last 4 weeks. That doesn't make a lot of sense, but so be it. So the signal here is that gold, if nothing else, we would likely see some kind of corrective move back to the T-cross long at 1871. But again, we must cross over 1848, that current quarterly opening price. Now, when we look at oil contracts here, once again, oil contracts approaching that yearly opening price. This will be an interesting week because again, there's a relatively high positive correlation between oil and the dollar index. As the dollar tanked, oil went down with it. But I believe that oil is the one that can break higher, not the dollar. Yes, I anticipate the Fed will try and hike one more time. But most of the Morgan Stanley and a number of larger firms are already betting on a March rate cut, and I would be in that camp too. I don't believe we should have ever hiked to 5% or more, but that's not my decision to make. So when we look at this right now, the indicators, we have a strong neural index strength that is pointing straight up. The predicted differences, they look like they're getting ready to cross. So again, for next week, 80.73, watch that level very, very closely. If we can hold above it, then this is nothing more than a corrective move because oil still remains bullish on the year. Now, my personal favorite in the month of, which I'm sure you guys already know, is Bitcoin. Every October, I've bought Bitcoin since 2018, where I refuse to listen to the media because, again, I don't believe the media is doing their job. They haven't been doing their job in many years. The annualized returns on Bitcoin are, I think, around 150% per year. It always has a very strong October. So good, bad, or indifferent, I'm going to stick with what I've seen and I'm going to trade what I see, not what I hear. So right now we are firmly holding above the quarterly opening price. That's what makes this level so important. The point in time indicator in Vantage Point does not look into rolling performance models of the last 5 days, 30 days, 300. No, none of that, guys. It looks at the current quarter, the current yearly, the current monthly and weekly opening price. Because again, we don't want to get into using these lagging tools. So right now, the quarterly opening price on Bitcoin is 27,072. So I'm looking for it to hold above that. Yes, we have a mixed signal here. The MA diff cross is down, but the neural index strength, predicted RSI, and we're holding above what I really like about this particular setup is the T cross long is coming in at 27,145, and it's intersecting with the current quarterly opening price, and that's provides a very strong level of support. If you're not in the camp of going along with that, I certainly respect that. Then have your sell limit orders ready to go below the quarterly opening price. But I think at this time, as the global currencies devalue, Bitcoin becomes more and more attractive, and the indicators in Vantage Point ultimately are supporting that. Now, as we look at some of the main Forex pairs going into this week, Euro US, once again, we were doing this one in the Vantage Point live training room this week. Newly formed verified support low, that's coming in at 104.49. My low for the month on the euro is about 104.29. We got close to that, but then it shot out of there. So again, the rising predicted RSI, the rising predicted differences, the rising neural index, and we've got a newly formed verified support. Now I could see it coming down and testing this, but of interest to us is again, 105.67. We're closing above that area at 105.84. That new quarterly opening price, this is a very simplistic methodology to apply to this. If we hold above 105.67, we break through the Vantage Point T cross long at 105.94, then we should easily be able to run up to 107. That could take a few days, it could take a month, or it could be towards year end. But I suspect it will be sooner rather than later because, again, I don't usually buy US dollars after the first week of November, and I'm already on the hunt for dollar shorts in mid-October. So we have that another week of dollar strength in the first week of November. But again, this is something we have to be careful of. Now, again, we need to break through this particular level. If we look at the counterpart to the inverse correlation to Euro US is US Swiss franc. You can see this is the power of using accurate pivot points, yearly opening price, monthly, quarterly, weekly. This is invisible resistance to the average trader. The current yearly opening price, 92.51. We went up, kissed it, came down, came back off of it, went back up to it, hit it, basically almost to the number and just collapsed. This is the easiest trade I had last week because I anticipate gold would rise, the correlation that the Swiss franc has to gold, and either way, I anticipate the dollar would move lower in the coming week. So again, right now we're at the T-cross long, our quarterly opening 91.55. We want to try and hold below this, but what I would like to see is a breakdown below the T-cross long at 90.86 to accelerate this move to the downside. And I suspect by year end, even with another rate hike, we're still likely to push below the 89 mark. Now, the British pound, again, it's impossible for me to script this, guys, because we know this level ahead of time. We don't care what the last 4 or 5 days are, the last random 30 days. Again, this just simply evidences what I've stated, that it's a lagging tool. The yearly opening price produced a fantastic long right there. The T-cross long has contained it. We've come down this past week, slipped below the weekly opening price for a couple of hours, that's it, and then shot right back out of there. So going up 200 pips on a single contract, you're talking $2,500, $2,000, excellent trade. The Vantage Point indicators clearly allowed me to start to get long on this as the neural index started to rise. We move higher. We have a newly formed support low that's coming in at 2037, a classic bear trap here, guys. And this is what we really need to watch for. But the average trader, the media was very dovish on the British pound, the Bank of England, all that stuff. But guys, it's just media noise. If it's a true move to the downside, we're going to need to hold below the yearly opening price at 120.97, and we couldn't. It provide for this savvy trader. There's been multiple longs here that have worked very well. And again, the immediate support we have is the quarterly opening, 120.93. We've got to break through 122.49. We break through 122.49, it will confirm what we already suspect, that the dollar is bullish into the end of the year, or bearish into the end of the year on the dollar, bullish for the pound, and that is also supported, I might add, by the current seasonality. Now, when we look at the dollar yen, again, at the beginning of the week in the Vantage Point Live training room, we discussed this and I said, okay, well, if the dollar is so strong, what the media is telling you, then why is it losing ground against all things the Japanese yen? This by definition is the carry trade, meaning buy dollars, sell yen. The interest rate differential is the biggest between these two, and the dollar still lost ground. Now, again, there's intervention worries. But again, only in my respectful opinion, this pair should have never got to this to up here. But my opinion doesn't matter, just like everybody else's opinion. It's just an opinion. So I don't want to fight the trend, but if we're holding below the quarterly opening at 149.52, this is our focal point, guys. Keeping an eye on this particular level will tell us on a price action based who's in control of this, the bulls or the bears. I believe that the bears are going to take hold over the coming weeks, and I believe the Bank of Japan is thinking the same thing, and they're going to use that to their advantage by putting out rumors of intervention. That is what my concern here is. The primary trend is up indisputably, but if we're not getting above the quarterly opening price, and we know that the dollar struggles in its fiscal first quarter, then there could be a very good short here, but just be very, very cautious with this pair. Now, the main equity-based currencies, again, the second the S&P 500 turned and the dollar turned, the Canadian dollar immediately benefited from that, despite the fact that oil prices plummeted. The Canadian dollar immediately reacted to a risk-on scenario or a softer US dollar, even with even with those oil prices not really recovering. But again, the oil prices are still above their yearly opening price. They're still positive on the year. So right now, our quarterly opening price is a considerable distance away at 135.60. I anticipate this level will be tested next week. If we break down below this, then that will open up the door to a deeper move on this particular pair, likely towards the 134, 133.81, but we must cross over the current yearly opening price, the current monthly opening price, and the current quarterly opening price. All of that resides around this 135.60 area, guys. So if you're not sure, then you can just set up limit orders below the current quarterly opening. That is the advantage of using non-lagging rolling performance models. We know exactly where this level is. If you don't want to go long, you're not sure what to do with it, then let it come down and test this area. If you believe it's going to go higher, then you're a buyer at 135.60. But if you're a seller, then you set up just below the current yearly opening price and prepare for a move lower. The indicators in VantagePoint are saying at the very least, the neural index, a sharp fall in the neural index strength, the MA diff cross, the neural index is on board, and the predicted RSI is also falling. But again, for now, it's corrective in nature until we break through the aforementioned levels. Now, the Aussie, as discussed last week, the week before, if the equity markets turn, the Aussie will turn with it. And that is something we would definitely, it's potentially in the cards. So if we look at this from the shorter term perspective, you can see that basically the Aussie has not made any moves to the downside since Tuesday of this previous week. We started to turn around on the Wednesday, Thursday, and the Friday. The quarterly opening here, 64.34. I think you know the drill by now. We need to get above that, but we also need to first clear the Vantage Point T cross long at 63.92. But if we get above our quarterly opening price at 64.34, that will confirm bearish sentiment on the dollar going into year end, or at least for the next few weeks. The same thing here, guys, would apply to the Kiwi, and I would argue the Kiwi is the stronger of these two. And again, for the savvy trader, in my direct trading group, we're shorting Aussie New Zealand. We're avoiding Aussie US and New Zealand US and targeting the Aussie New Zealand cross pair. And again, when we look at the Aussie New Zealand cross pair, this is in a firm downward trend, and you can see using accurate, powerful tools like the point in time, this provided excellent shorts every single day for me last week because the bias is the Kiwi is stronger in the month of October. So instead of, again, there's many different ways to skin a cat here, guys. If I don't want to short dollars on Aussie US or New Zealand US by buying those two pairs, I can bypass them and come here to Aussie New Zealand, a very, very powerful cross pair that is in a very nice trending move. And using that quarterly opening price, I'll simply take 40 or 50 pips per day. But by the end of the week, that's close to 200 pips on the week, just day trading using the VantagePoint T-cross long or long predicted and the VantagePoint point in time and the additional indicators warning me that we're still bearish on this particular pair. So with that said, this is the VantagePoint AI Market Outlook for the week of October the 9th, 2020.